You've got the sales, you got the customers, you got 2, 3, 4 years of proof that your business works, and you still get told no. No from the bank, no from the SBA line that you waited 6 weeks for an answer on, no from the loan officer who looked at your file for 4 minutes before he found a reason to pass. Here's the truth that nobody tells you. Being credit worthy and being bankable are two different things. And if you're a small business owner who doesn't fit the traditional mold, thinner personnel credit history, less inherited capital, no rich uncle to co-sign, the traditional door was never really built to open for you in the first place. So today, I'm not going to waste your time explaining why that's unfair. You already know that. Instead, I'm going to show you exactly where the doors are, the ones that are actually built for businesses like yours, and how to walk through them with a plan instead of a hope. I've sat across the table from owners who have gotten denied 3 times before they found the right funding source. And it wasn't because their business was weak. It was because they were knocking on the wrong doors with the wrong pitch. Here's a number that should make you sit up. Small business owners owned by people of color are approved for traditional bank loans at roughly half the rate of their white counterparts, even when the revenue and credit scores are comparable. That's not a competence gap. That's a system gap. I coach growing businesses through this exact moment. The point where you've outgrown bootstrap, but you haven't been handed a clean path to real capital. So let's fix that today. Here's what we're breaking down in the next few minutes. 1, while the bank said no, why did they say no and what exactly that means? 2, the 4 alternative capital sources most owners never research. 3, how to build a funding-ready file before you need the money. And 4, the one pitch mistake that kills your approval odds instantly. By the end of this, you'll have a real action plan, not just a list of feelings about how unfair banking is. So let's talk about understanding what no actually means. When a bank says no, they're not saying your business is bad. They're saying your file doesn't match their specific risk model. Traditional banks are built to say yes to low risk, high collateral, long history borrowers. If you're 2 to 5 years and growing fast and reinvesting your profit instead of sitting on a fat balance sheet, you look risky on paper, even while you're thriving in real life. I work with a boutique catering business, 3 years in revenue up 40% year over year, denied twice by traditional banks. Why? Seasonal revenue saving scared the underwriters, even though the owner had 18-month contracts already signed. The bank's model couldn't see their actual value, their actual business. It can only see the shape of a spreadsheet. Action step. Pull your last denial letter or ask your loan officer directly for the very specific reasons. Just don't accept your application wasn't approved. Ask why in writing. That reason tells you exactly which alternative or alternative lender will actually say yes. Number 2, know your alternative doors. This is the part most owners skip because it feels like extra homework. Don't skip it. This is where the money actually is. Door 1, CDFI is Community Development Financial Institution. These are mission-driven lenders funded specifically to serve businesses traditional banks pass on. They look at your cash flow and character, not just your credit score. Door 2, revenue-based financing. Instead of a fixed loan payment, you repay a percentage of the monthly revenue. Great for businesses with strong sales but choppy timing, like caterers. Door 3, microloan. Microloan programs often run through nonprofits or the SBA microloan loan intermediaries, funding $500 to $50,000 for businesses that don't need or can't get a massive traditional loan. Door 4, local and state small business grant program. Free money gets ignored constantly because owners assume it's too competitive or not for me. A lot of it goes unclaimed every single year. Action step. Today, search CDFI near me, plus your state name and bookmark 2. Then check your state's economic development website for one active grant program. That's 15 minutes for 2 real leads. Building your funding ready file before you need it. This is an important step. And here's a mistake I see constantly. Owners start looking for funding after the emergency hits. By then, you're desperate, and desperate applications get denied. I want you to build what I call a capital ready folder. Updated financials, 12-month of bank statements, a 1-page summary of your business story, and growth numbers, and a clear explanation of what the money is for and how it gets repaid. This is something that a lot of people forget. They don't know they're going to use it for a few things, so they just say, I'm going to use it for this. Know exactly what you're going to use it for and be able to tell the loan officer. So when you have this ready before you need it, you can apply 3 or 4 sources in one weekend instead of scrambling for 3 weeks. One of my clients built this folder on a slow Tuesday afternoon. 4 months later, when a supplier created a cash flow crunch. She had a CDFI approval in 9 days because she wasn't starting from zero. This is another action step. I want you to block 90 minutes this week. Build that folder. Even if you don't need funding right now, in the future, if you keep going the way you're going, you will. Fix your pitch. Okay? Fix your pitch lead with the business, not the struggle. This one's blunt, but you need to hear it. A lot of owners walk into a funding conversation leading with how hard things have been. I understand the instinct is true. It is real. But lenders aren't funding your hardship. They're funding your plan. So flip the script. Lead with growth. Revenue is up 40% over year, and I need $30,000 to buy equipment that lets me take on some contracts. I'm already turning away. That's a story that business lenders want to bet on. Things have been really tough and I need help, even if it's honest, doesn't give a lender anything to underwrite. And here's another action step for you. Rewrite your funding pitch right now in one sentence. Your growth number, what you need, and exactly what it produces. That's a sentence you lead every conversation with. Here's some mistakes. We all make them. You're learning. I understand it. So let's be direct about where owners kind of get it wrong sometimes. Mistake 1, applying to only one source and treating that no as final. One denial is one lender's risk model, not a verdict on your business. Mistake 2, waiting until it's an emergency to start the process. Funding takes time. Desperation shows up in your paperwork, whether you met for it too or not. Mistake 3, underestimating how much smaller, mission-driven capital is actually available. There's a lot available. Owners assume there's nothing out there for me, and they stop looking right before they would have found the door that was actually built for them. Here's what I want you to walk away with. A bank's no is not a reflection of your business, but of their risk model. They are real funding doors, CDFIs, revenue-based financing, microloans, and grants, built specifically for owners who don't fit the traditional mold. And the owners who get funded fastest are the ones who build a capital-ready file before they need it. So if this is home, do one thing for me. Drop a comment telling me which funding door you're going to research first. I read all my comments, and I'll point you in the right direction. So I'll see you in the next one. This is Mark Parham for the Entrepreneurial Edge.